Good afternoon, everyone, and welcome to Gray Gray and Gray's annual year-end business planning seminar. Let's segue into our panel discussion here. And we've certainly got a world-class panel for you here today, and a very pertinent and relevant topic, and that is preparing your business for sale. We've seen unprecedented activity in the M&A market in 2021, and there's no end in sight, really. And the unfortunate part, in the lower middle market is that most businesses aren't adequately prepared for sale. And we've had several folks say, I'm not going to sell my business. I'm going to pass it down to my family members. And that's completely fine. That strategy is completely appropriate. But your business should always be prepared for sale in the event you get the proverbial offer that you cannot refuse. So today's panel includes, as I said before, a number of experts and in this content matter. Paul, you recently went through a transaction, and I know over the several years prior to the transaction this year, you had spent some time preparing your business for sale. So why don't you give us some thoughts as to how that benefited you being able to consummate a transaction that ultimately you were very happy with this year?
Sure, Jim. Love to share some of the experiences we had there. One of the key maxims I think you always have to maintain in an industry, and we're in the AEC industry at Environmental Partners, is we always have the formula that you should prepare your business and operate your business as if you're going to sell it tomorrow. And sometimes that can almost happen. And it happened to us because of circumstances. And the other maxim is, if you're lucky as a business owner if you get to sell your business once, right? So there are some really key items, in terms of preparing your business for sale. And we began our business in 1997 and had learned a lot in the industry, learned how not to run a business from some of our experiences. And we took that, forward in Environmental Partners. Some of the key items I would advise folks that are thinking about selling their business is to straighten out your operations, right? Clean up your house. So you're running efficiently, you're using a solid accounting system, and don't let operating and personnel problems drag out. You always want to identify them as soon as you can and begin correcting them. Always operate using your key performance indicators, your KPIs. You need to know them for your particular industry and manage them better than the peer group. Again, you're preparing your company for sale. So you want to be a standout if you can at all achieve that. And some of this takes time. If you're behind, you need to begin. These programs typically take 4 to 5 years, sometimes more. And there are a lot of things we'll talk about here today, but the KPIs, you need to understand your multipliers, utilization rates, right? Overhead, cash management, your accounts payables, accounts receivable. You need to have command of all of that, especially aged ARs, because they affect your working capital and your profitability. But you always want to achieve steady growth, steady profitability gains year on year, and maybe as important as anything from the buyer perspective is to have a really strong talent bench behind you as owners or principals in firms. And one of the things that stuck with me from years of involvement in the industry was the CEO's number one job is to find their replacement. And if you take that philosophy with you day to day, you will find good people. And you need to make sure that kind of philosophy is worked down through your organization. All your key people in the organization need to think like that, especially if they're owners. They owe that to the company to think about replacing themselves, because anything can happen to anyone at any time, and circumstances in the industry can change where a sale becomes optimal or necessary. So build that bench and make it grow, make it work throughout the organization.
So Brian, tell us a little bit about, Paul had mentioned, in terms of strategic planning and getting the business situated so that there is a clear path forward that can be articulated to a potential buyer. What are some of the things when you're sitting with business owners that you would advise them to do there?
Sure, thanks, Jim. So I like to look at 6 areas, one being the customer. And, I think the first thing that a buyer or an investor is going to look at is what is the behavior of your customers? Do you really understand the various segments? Do they like doing business with you? Are they loyal to you? Are they satisfied? And so on. And so I think really having a good understanding of who your customers are and being able to make sure that they will be good referenceable customers and continue to grow their revenues with you is really important. Paul mentioned the importance of team and particularly having a deep bench. And so much of the work that I do, you see, a layer at the top and a layer at the bottom and nobody in the middle. That is really going to be the heirs apparent to replace the 60-year-olds that are sitting at the top. And I think that's something that really will scare off buyers, particularly financial buyers. Leadership and governance is a part of that as well. Paul mentioned finance and the importance of working capital management and revenue and profitability growth. So I think anything that you can do to be more efficient on your operations, make sure that you have those indicators of growth and revenue and understand what drives those, as well as ways that you can reduce costs and improve margins, so be able to grow profitability are really important. I think we also look at, how do companies grow? And part of it, of course, is organic growth, but also, what we're seeing is transactions that allow growth by M&A. So are there various types of tuck-in acquisitions or adjacencies that could really help to grow the business more rapidly? And then, of course, in this environment, not getting caught short by supply chain challenges that really are going to limit your ability to grow because you simply don't have the products to sell. And so making sure you have whatever redundancy you can build into the supply chain. Admittedly, it's very difficult right now in some industries, but looking for ways to make sure that you're not going to get caught flat-footed and not be able to meet your sales targets because you don't have the product to sell. So those are some thoughts, Jim.
So Derek Rebello, tell us a little bit about when we talk about getting your house in order from a financial perspective, and then Kelly, I want to throw it to you as well from a tax perspective. How do you get your house in order so that you're not slowing down diligence, right? Does every financial statement have to be audited? Does every tax return have to have all appropriate deductions and elections in order to get through diligence? So just give us a little sense as to what you're advising your clients as they prepare for sale.
Absolutely. All clients should be audited by Gray, Gray & Gray. Now that's too self-serving, but I think Paul brought up a great point that you have to kind of think about how you present your financial statements and how you run your company. From our standpoint, we're coming in on buy side and sell side to do these due diligence reports called quality of earnings reports. And I can't tell you how many times you come in and, company hasn't been audited or doesn't have reviewed financial statements. They haven't been sort of mindful, thoughtful about the process. Maybe ran the business like a personal, personal banking, just basically running off of all the personal expenses that are running through the business and everything else. And so, there's a time kills all deals, and to the extent that you're not ready for sale, you really need to think about how people are going to perceive your business, right? So I think, we talk about you would never sell your house without, painting, maybe brushing up the paint and fixing the fence that's knocked down. And so it's the same thing with your business. And so the other aspect of it is that, there's this thing that you talk about EBITDA, right? Earnings before interest, taxes, depreciation, amortization. So many times people will meet with the investment bankers and business brokers or their accountants and lawyers, and they say, well, it's based on a multiple of EBITDA. And so they go back in the lab and they start thinking about how they've adjusted. How can they adjust EBITDA? And these are the add backs, right? And that's where these personal expenses and one-time expenses and everything else. So really, you have to think about where your kind of skeletons are buried and how you're presenting the information, that it's done in a thoughtful and professional way. And so that you don't hold up the deal. And ultimately that's what happens, because We'll talk a little bit more about that during the panel, but you still have to run the business and then prepare your company for sale. And it's hard to keep that going and not impact the business going forward. So it's all about sort of thinking about, you have to be audited, no, but you need some kind of financial statements. You have to, get the process going. All deals are different, but those are deals that work the best are the ones that have a more thoughtful approach to it.
Well, and I think the other aspect to that, Derek, is that a lot of businesses in the lower middle market, they're lifestyle businesses, and they're tax averse. They're trying to defer as much in tax as they possibly can. And Kelly, sometimes, the best advice, believe it or not, is maybe pre-transaction, you might have to pay a little bit in taxes in order to position your business for sale. So give us a little insight into the tax aspects.
Yeah, so I think, it depends on the client, but I think taxes are difficult, right? And understanding taxes are difficult. And I think the smaller the client, the more sometimes things are overlooked. And I think it's not, making people feel badly about that. It's really just understanding where, issues may lie and understanding and quantifying what those issues are. Because I think in diligence, it's best to understand what those issues are, be forthcoming with that, and not wait for the other side to come up with the issues and make a bigger deal about it than it really is, right? So it's really understanding where the issues lie, understanding why certain things were done, and positioning your business in a way where you are in a position of strength and not sort of caught off guard by issues that are found by another firm, because, they're not trying to be mean. That's really what their jobs are, right? So a buyer comes in or an investment banker comes in and they hire somebody else to do diligence. And the last thing you want is to be sort of caught off guard and find yourself sort of in a defensive sort of situation.
And Kelly, what about tax structure?
Yes, we're doing a lot around tax structure, a lot of work around modeling, which I think is huge. Always important to have some sort of waterfall in place and get a sense for what you will net at the end of the day. Whether you have an asset sale or a tax sale, you could have phantom stock, you could have all sorts of stuff. And I think it's essential to have a model going early and update it basically live all the time, right? So when you get, depending on the LOI, the deals could look very different and it could yield very different results, regardless of whether it's an asset deal or a stock deal. And, there's purchase price adjustments that get you to where you eventually want to be, depending on whether you choose an asset deal or a stock sale. So it's really, modeling is hugely important.
And Paul, I want to circle back to you because Derek Rebello mentioned something that I want to get your take on. As a business owner, when you're going through a process, you have the unenviable task of having to run the business like you've always run it while you're trying to sell the business. And sometimes that can be a monumental task. So why don't you give us a little insight as to the challenges you face trying to juggle both?
Sure. We were fortunate enough that the business was in really good shape. So when the opportunity arose to sell the business versus do an internal transition, we were planning on internal transition for years, but the market conditions in our industry really changed radically over the last year, right? So it became apparent that it might be more advantageous to sell outside, and all of the owners of the company, we had a number of minority owners as well as major owners, all agreed on that. So we went forward with it, but because of the good condition of the company in terms of its books, its operating history, its client base, we were able to glide into it. We weren't fixing things while we were trying to respond to questions. So, and we had a great team. Don't ever think about going into this alone. You need a good accountant. We had Gray, Gray & Gray for years. They knew our books. They audited us every year. So you guys had a complete command of the picture of the financials of the company. And we had a really good legal team that was highly experienced. So we went in well armed, because you are going to get scrutinized. This is 24/7, 3 months of scrutiny on every aspect of your business, inside out, backwards, 3 times over, by people trained to do exactly this. This is what they do. They, there's a fee or a price set up, and then they try to find ways to reduce that over time because there may be issues in the company. Whatever the weakness, the chink in the armor might be, if there is any there, they're going to find it. So you have to be prepared, and we did that. And but you do have to be able to handle it internally. We fortunately, in addition to myself, we had our chief operating officer and our controller who had complete command of operating metrics, financials, day to day, month to month, year to year, 3 years of history being scrutinized. So that team internally running the business, but also handling the inquisition, so to speak, with the help of your counsel and your accountants is the only way to go. Otherwise, you really can't do both at the same time. Well, you're going to fail at both of them if you don't have the right team put together and have that internal command already of your operating system, and you can answer any question that's asked. And they will ask for explanations about everything, Jim. You know that, right?
Sure.
3 times
Sure.
they come back and triangulate. So that's the advice I would give. Be prepared. Don't take it lightly. And the better prepared you are, the more they'll respect that as well. The buyer respects people that have in firms that have their act together. It just increases the value, the inherent value of the firm.
And Brian, tell us a little bit about, how, when you're advising clients on strategic business planning, how do you help them prepare for that balance that Paul was just trying to talk about, that juggling act between making sure the business is going to continue to run if the owner and the management team can't devote 100% of their time, day in and day out during the transaction?
Yeah, no, it's a really important point, and I think part of it is just don't rush these things. Jim, you mentioned, it's all about what you net, and it looks like we may have dodged the bullet to some extent on, capital gains on the sale of businesses in 2021. We'll find out at some point in the future, but it's about what you net. So if you're not prepared, you're better off to grow the value of the business over time in many cases, and deal with the tax regime that may be enforced, whenever it's the right time to sell the business, but don't sell it prematurely because you may not net as much as you might have otherwise because the business may not be as well prepared. And I think, I mentioned those 6 items, and I think really making sure that as you grow the business, keeping those in sync or in check so that, you don't ever find yourself in a situation where you have a hard driving, sales oriented CEO and he or she is maybe pushing for growth, but you don't have the infrastructure in behind to support it, whether that's working capital or whether it's the right team or the right production capability. So those things have to be kept in balance. And I'm sure, Paul, as you grew your business, you had to deal with that every month, every day, that it's really important to have a strategy that says this is what we want to do. But these are all of the things that we need to have in order to achieve the goals that we set out and ultimately the value that we hope to deliver in our business.
And Jim, I would just add to that, is a really great point. You need to have choice, right? You have to have choice in the matter as a seller. And if the better prepared you are, you want a matchup. You want a good cultural fit with a buyer. You don't want to have to settle. So the healthier you are going into it, the more prepared you are going into it, the more likely you are to have choice about who you match up with. And you're not just settling for something less. So just make your firm as attractive as you could possibly do it in every way. So when the time comes, if the time comes, you're able to achieve a match as well as a good price on your company, because you're not going to just walk out. You've got a cadre of people. All of the employees in the company are looking to their future. You're responsible for that as well, and leaving the company in a good position strategically to move forward and not just walk away. You have that legacy to uphold. We felt very strongly about that. So we were not going to do it with just anybody. It needed to be a match that strategically fit our long-term goals and objectives as a company.
that. So Derek, when you're on the sell side, and Harry's advising his clients in the appropriate situation to get a sell side quality of earnings review to kind of kick the tires, what are some of the areas that you focus on in a sell side Q of E, and why would you perform such a service? Because to Harry's point, a lot of folks look at that as an operating expense as opposed to an investment. So what's the benefits? What are some of the areas that you jump into and support the businesses on?
Sure. So, quality of earnings report is basically a consulting report that tries to get at what are the true earnings of the business, right? What are the predictable cash flows? And different Q of E reports include, different things depending on scope and everything else. But at its core, it's trying to get at what are the true cash flows of the business. And that includes the operations. And then we're looking at sort of one-time, income and expenses, things that are happening in the business that maybe will not be continuing going forward. And then this idea of add backs, right? Where, perhaps you have family on the payroll, or you have certain expenses that you're incurring, or certain investments that you're making that you want buyers to consider from there. But the biggest benefit is to Harry's point about where is the exposure, right? Because there are things, where, I spend probably half my time doing these types of reports, and the other half being an audit partner for businesses. And auditors take certain, materiality and certain judgments that are happening throughout the financial statements where, maybe on an earnings side, it might be impacting cash flow. So I told you earlier that you meet with the investment banker or the broker, and they tell you that your business will trade at a multiple of EBITDA, and then you have these add backs, and then they go back and they start going crazy on there, and that could significantly impact maybe how you're recording your business, right? So maybe you'll take all the reserves down, and you'll say, I don't need allowance for doubtful accounts, I don't need to accrue for vacation anymore and other retirement benefits and things, and start doing weird things in the numbers, or maybe there are other adjustments happening. So having that sell side due diligence is trying to get back at what's reasonable on the add backs, what are the true earnings of the business, and sort of what's going on. We try to get at working capital. Harry mentioned, the LOI. Oftentimes, I can't tell you how many times in a process where they kind of kick the can down the road and they say, we'll address the working capital later. And really the seller doesn't understand, they say, well, wait a minute, it's all my receivables, it's all my inventory and all payables. And it's like, no, you've got to leave some working capital behind. And in some deals, it could be a major issue as to what the customer is deeming, as value from that standpoint. Spent a fair amount of time going through the add backs, and especially businesses where they're continuing, what is your salary today? What are the salary going forward that you would expect from a package, and sort of defending that on the future cash flows. And then in every deal that we've had now is COVID, right? So we've had businesses that have significantly been impacted by COVID, both negatively and positively, and trying to isolate, what are the actual earnings of the business and what can continue going forward. We'll also try to address those state and local tax issues and other things that are just going to sort of pop up on a deal that would cause some concerns. And I would just say beyond, just the sell side due diligence, there in a normal M&A process, there's other diligence that's going on as well. It's IT and customers and HR, and there's just so many other things that are going around, and just being prepared for all of that. But getting a sell side due diligence report kind of sets the stage for it. And ultimately what's happening is you're trying to limit, I said time kills all deals. And what you're trying to do is to, put your best foot forward. Here are our numbers. And many times we're on that side of it. Now I'm working with a consultant that's buying the business, and we're going through the numbers and our assumptions and sharing our data book and going through what we've gone through. And hopefully that makes things go faster. And there's not a lot more. I mean, they're obviously going to have questions, and they might reaching conclusions, but if you're thoughtful about it and you've defended it and you provided it, it makes the process go quicker.